in an environment which is fragile, I think the stability aspect actually scores quite well. With respect to markets being exuberant or otherwise, I think the froth that we witnessed, say about a couple of years ago, is kind of damped down quite meaningfully. And so, if we were to look at a simple yardstick of say our our GDP share, for example, as a percentage of the world economy is close to about 3.3, 3.4%, and our market cap share is about 3.1%. So it doesn't really point out to something very stark out there. But
Sure.
yes, within that, of course, there are some pockets which are overvalued, some pockets which are undervalued, etc. But I think it is important to keep the bigger picture in context that it's going to be a shallower growth, but hopefully a longer growth cycle this time around.
But I do want to check with you in a slightly shorter fashion as to why you constructive IT. I'm moving tracks completely, but it's an important one considering that the results haven't been great. Considering that a lot of people are saying that even the second half recovery is a bit sketchy. So why are you penciling your hopes there? Quick 60 seconds if you can.
The key aspect to look at is how FY25 comes through. And now, of course, one can say is that if people don't have visibility of FY24, how is it that you have any visibility of FY25? But which is where you look at longer term trends, right? And you try and get parallels out there. So if you look at, say, for example, Europe, which was in the storm, last year, and you look at even this quarter wherein results were generally weak, Europe has actually been extremely strong for most of the companies. So the point really is that this is companies want to go into this kind of spending. It is that they are buffeted by all of these uncertainty, and therefore they want to hold back for some time. And therefore, as and when that eases off, you're going to see a bounce back. So that's point number one. The second point that we look at to get some comfort is more in terms of what we look at profit pool shares. So if you look at profit pool shares of the IT sector, it's been a growing sector. And when I say profit pool share, what I mean is profit pool of IT sector divided by the top 1,000 profitable companies which are listed in India. So just very quickly, in the dot-com bubble, it was 5%. That went on to about 7-8% at GFC. And then from there, it went on to about 12-13% of total profits pre-COVID. During COVID, it went to about 15%. And today we are at 9%. So the call really that one is wanting to take is that in 3 years, can this 9% go back to 12-13%, which was there pre-COVID, or is it likely to go to say 7-8%, or is it going to stagnate at 9%? And while there is clearly a downside in terms of earnings, etc., that come through in this first half and possibly in the second half also, as you rightly pointed out, I think the call, if one has a 3-year view, would be that, well, 9% go to 12%. And to that, I would think that there is a good chance of that happening.